From New York City for our viewers worldwide, I'm Taylor Riggs in for Jonathan Ferro. Bloomberg Real Yield starts right now. Coming up, the Fed adding fuel to the taper debate. Junk bonds signaling that the inflation trade might be getting long in the tooth. All of this is sending investors racing back into the world's safest debt. But first, we begin with the big issue. It is the great taper debate. It's marching on.
It was a surprise to hear the talk about Fed tapering.
Earlier this year, it was, we shouldn't even be talking about it.
The Fed's been extremely consistent in their language.
Now they're talking about it.
They explicitly put in there a discussion on tapering large-scale asset purchases.
The system is awash in liquidity.
The Fed is just sitting on the market.
We now entered a different world where genuine inflation concerns are mounting.
Inflation is a very real risk.
And also genuine concern about financial stability are mounting.
The risk of policy error is rising.
I would start to taper.
They're running the same monetary policy as 13, 14 months ago.
Move away from emergency conditions.
Joining us now, Invesco's Noelle Corum, AB's Gershon Distenfeld, and George Rusnak of Wells Fargo. George, let me start with you. I was reading through your notes, and finally, the Fed is talking about tapering, even though a few months ago I thought we weren't even thinking about tapering. Were you surprised this week?
I was happily surprised, actually. I think it's a healthy thing, right? From a sequencing perspective, from a timing perspective, they should be talking about tapering. And, you'll probably, again, keep in mind, what are we talking about here? We're not talking about tapping on the brakes. We're talking about letting off the gas a little bit. And when you're buying $120 billion a month in treasuries and mortgage backs, you should be at this time starting to talk about tapering. And the timing around that is probably going to be around August sometime, around Jackson Hole, maybe in September, and then maybe easing towards the end of the year. If they do it sooner, we think that's better. But I think it's important for investors to get in their minds that in the past, where the Fed has kind of waited to see that they see the whites of their eyes of inflation, they're now waiting until they see inflation in sort of the rearview mirror. And so that's the key point here. And the question is the market going to allow them to do that?
Gershon, you have a similar point. You're now looking at a Fed to begin tapering later this year. So we're going to be talking about it now and the tapering. How do the markets respond to that?
Look, at first, I think to George's point, I think the Fed did a really smart thing. They really gave themselves optionality. And the truth of the matter is that as high as, let's say, the CPI print was unexpectedly a couple of weeks ago, the near-term data is not the issue, right? We expected, as demand has come back, supply chains are still broken, we expected near-term inflation. The question is it going to be persistent? I think what the Fed has done here very smartly is said, let's see where we are later in the year. How are the markets going to react? Who knows? I'm mystified by the fact that essentially financial conditions have gotten easier in that we've seen inflation break-even rates spike in the past few weeks without a real change in yield. So real yields are actually lower as the economy is recovering. That's something the market's going to have to work out. Something just doesn't seem right about that.
Noelle, what do you make of that? I was pleasantly surprised by the equity volatility this week, and bonds appeared to be relatively well behaved.
Yeah, we have kind of been looking at it over the bigger picture. So in June, we thought maybe they'll start to talk about tapering. So we're a little bit surprised by the pulling forward. But again, they want options. If we look at history, even though we have one taper to look at, they did use several meetings to discuss it. So they are giving themselves options. They do want to be able to announce tapering potentially at Jackson Hole or later. We think the data kind of for now will point to later, even though we do expect strong growth, mixed inflation. We just think that the Fed's not going to be quite confident. But the discussion is definitely going to continue, and that's just going to give them the option to be able to say, hey, we are tapering, this needs to happen, and that's that.
Some of the about face came from Kaplan, and then you have Bostic weighing in. Atlanta Fed President Raphael Bostic weighed in, this time on the volatility, expecting more along the way.
I'm expecting a lot of volatility over the next several months. In the last several months, we've had data points that have not met up with expectations. I think that's to be expected. And what that will mean is that we're going to have to do extra work.
George, are you expecting volatility? How do you manage volatility?
Yeah, you have to expect volatility in this market because your year-over-year comparison is just so low, right? Your baseline effects are going to be crazy. And as we resume sort of the normalcy within the markets and within day-to-day life, you're going to have bumpiness in the data itself. But what you're seeing, and you're definitely seeing some concern and bumpiness in the data, but overall, you're just seeing positive growth, positive inflation. Employment obviously took a little bit of a hit, but it's actually directionally going the right way. So I think that's what you're going to have to see is not necessarily each specific issue that happens, but more the overall larger picture and the duration of the direction of it, which we think is very positive overall.
You know, Gershon, one thing that really stood out to me is we had a chart showing correlations of equities to bonds. They're actually pretty high. How do you think then about bonds in this inflationary environment? Is it a hedge? Is it the appropriate hedge? Is it too correlated to equities? What do you do?
Well, Taylor, obviously, we tend to lump the bond market into one large thing. The higher yielding part, corporate high yield, emerging market debt, is usually pretty correlated. I think it really goes back to what is the definition of volatility. It was interesting to hear him say that. Equity volatility has typically been muted in periods of rising inflation, especially when break-evens have been going up, while underlying government bond yields tend to be very volatile, as we don't know the extent or the magnitude of the inflation that's yet to come. So, and then you look at the third leg of that stool, which is, again, the credit markets, emerging market debt. There's probably going to be continue to be a lot of demand there. If Feds taper or not, their rates are going to be near zero for a long time. There's just an insatiable demand for yield out there, and we don't see that abating anytime soon.
Noelle, do you agree with that? Does a 10-year today at a 162 appear to be relatively risk adjusted? Is that an appropriate risk adjusted reward where we are at these levels?
We do think it's going to be pressured higher from here, and that's largely on our growth and inflation view. Inflation's going to get messier. It's going to be pressured higher. The curve's going to be pressured steeper. We really think we have quite a bit of room to go in the 10-year. And that could potentially weigh on rate-sensitive assets. But we think growth fundamentals will be supportive for credit assets overall, and it still makes sense to stay neutral, close to your benchmark, while taking incremental risks throughout.
All of you are trying to front run my credit conversation, which is happening in the next block. I know we'll get to it. One more question here, Noelle, on inflation, of course, because that has been the key term. Is it transitory? Is it not? How do bond yields respond to a market that doesn't feel like it's transitory, but a Fed that keeps insisting it is?
We continue to think it's transitory, and that's just because we're looking at the underlying data. So if you look at the used car jump that, is largely coming from supply chain disruptions. If you look at the out-of-town lodging, that's largely coming from a reopening, and that's not things that we saw post the pre-pandemic. So these are things that we expect to abate over the summer as unemployment reduces, as we get the supply chain disruptions reducing. We think that, these are all transitory things, and we don't have a lot of data or confidence in the data that these things are here to stay. And that's ultimately what the Fed's going to hang their hat on.
George, do you agree? Is inflation transitory?
Yeah, I think, just what we were talking about before, the bumpiness of the data, it's going to be bumpy, unfortunately, in inflation as well. And so you're going to have some periods where things are going to spike and come down. From our perspective, though, we do think inflation is going to be picking up pretty significantly here. The question, though, to your point is it transitory? We think so, but it's going to have a longer tail than it has in the past. It could go even into 2022. I think that's an important distinction.
It was interesting in a Bloomberg opinion piece before the Fed minutes, and that's the key term. It was Muhammad Al-Arian of Queens College writing, quote, "Not only does the U.S. Central Bank appear to be lagging behind developments on the ground and the emerging consensus among some other central banks, but it's also being held hostage to a monetary framework that risks being ill-suited for a COVID-disrupted world." Gershon, give us our final take on this. It was interesting in a similar piece. It was Muhammad also writing that the Fed's point estimate seemed to be off instead of a range of scenarios in which it could enable the Fed to be more flexible. How are you thinking about a Fed that might be looking at a wrong point estimate instead of a range of of scenarios?
Look, I think the honest answer is the Fed really doesn't know if inflation is going to be persistent. I tend to agree with both George and Noelle that it's going to be transitory. You look, it's not just, I think Noelle mentioned used cars, it's flights and hotels, the stuff that tends to be more persistent. We're not seeing that spike. So the supply side, what it comes down to is the supply side of the US economy resilient enough to meet that demand over time? We're betting it's yes. But the Fed is basically saying they're not saying it explicitly, but implicitly, the Fed is saying we're not sure. We want to keep our options open. And yes, the risk of a policy error, the risk of being too slow to taper and to hike is there, but they're taking a wait and see approach.
Well, lucky for me, everyone is going to be sticking with us, and we'll get to that credit conversation. But first, up next, it's all about the auction block. The junk bond market remaining in favor amid sliding equities and surging volatility. That conversation, one of my favorites, it is next. This is Bloomberg. I'm Taylor Riggs in for Jonathan Ferro, and this is Bloomberg A Real Yield. Time now for the auction block. We're going to kick things off first in Europe. Issuance topping 45 billion euros with 12 issuers coming to market on Thursday, making it the fifth busiest week of the year. And a robust start to the high-grade debt sales in the U.S., almost $29 billion pricing in the first 2 days of the week before petering out amid rising volatility. And companies selling nearly $13 billion of debt in the U.S. junk bond market this week. Demand remaining for new issues ranging from acquisitions to loan repayments. Noelle, Corum, Gershon Distenfeld, and George Rusnak still with us. And Noelle, I've been eager to talk about the credit markets because everyone has been pushing in to the lower and lower rated sector. And I'm curious if this is a risk on signal or if this is FOMO and spreads are too tight.
So a lot of it's been happening because we've been seeing that rates volatility, and typically the lower rated stuff is, not as sensitive to rates risk. But if you actually look at the spread differentials between single B and triple C, for example, they're at very extreme lows. Basically, all of the upgrades that we have expected for 2021 are priced in at this point. So it doesn't make a lot of sense to put your bets there. Instead, it makes sense to put them in double Bs, which have lagged this year, and we can talk a little bit about why, but have other than the rates risk, but they've lagged this year, and we think there's price appreciation for not only for IG investors, cross investors, but also for high yield investors as well.
George, do you agree? Because we have a terminal chart showing, of course, what Noelle has been talking about. Triple C's have been the big outperformers, but you go up the credit scale and performance has lagged, at least on a year-to-date basis. Are the appropriate risk-adjusted returns still there?
Yeah, they're really, in our case, they're not. We've kind of pulled back on high yield. We were favorable at one point, and actually just in the last month or two have moved to neutral on them. And because of some of the concerns that Noelle's mentioned, I think it's really important. It's a credit-specific market, right? We agree that the double Bs, the possible rising stars, might be some good opportunities. But once you start getting down in the credit spectrum, you get into a lot more challenges. I mean, you're looking right now at OAS spreads that went from 285 to 310 this month, right? So they've just backed up recently here. You're looking at flows that have sort of reversed from last month. And now, but the good sign is you're actually still seeing tremendous demand for fixed income. And that demand is the lifeblood for high yield and will allow that to continue going forward, which is one of the reasons why we're neutral on it, not negative. So it's still good opportunistically. It's just not as attractive as it was several months back.
Gershon, square something with me, though, because some of the calls that I've been hearing about high yield is a lower modified duration. And with investment grade, you have to take on some of that duration risk. So while I know that the spreads are compressed and maybe you're not getting as much of a return as you thought, is it the lower modified duration play? And that is the case for high yield.
Well, certainly, lower duration profile helps you if rates are going to be rising, but I think it misses a very important nuance right now. The high yield market, or let's call it the double B and the triple B segment, there's a huge bifurcation out there. You have a lot of the older issuance with higher coupons, very high dollar prices, but you also have lower dollar price, low coupon paper that has much better convexity. You want at the same yield, you want to buy the much lower dollar price paper. There's over 300 billion of that paper in the double B, triple B land. that just has much, much better total return prospects over time. So I think investors have to pay attention. Look, especially in high yield, there is prepayment risk. I know it's not like mortgages, but most bonds are callable. If I could just weigh in very briefly on the triple C controversy, I think I differ a little bit there, Taylor. One of my pet peeves, I think the spread relationship between triple C's and single B's is completely irrelevant. It's distorted whenever you have something very high trading, it defaults. All of a sudden, it looks like your spreads have tightened, even though the quality of the overall universe has gotten higher. So I'm not going to make the case that they're incredibly cheap here, but we've just been through a cleansing out of lower rated companies. We've had a lot of defaults, a lot of restructurings, the weaker players are gone. And that's why it might not be as dangerous as some might think to waddle into triple C's.
Noelle, where then do you go? What do you like?
So we, again, like that double B to single or triple B play. We also like leverage loans. We think the upgrade cycle is still going to be relevant there. And demand is there. They did underperform in April when you saw rates kind of pull back, but they still posted positive returns, and the demand has been there throughout the year. And so that's where we think it's a good play, especially if you are sensitive to that rates duration. Of course, duration is 0.25 relative, high yield is over 3, IG over 4. So again, something to think about here if you are sensitive to that rates risk.
George, is there a risk, though, that all the supply that was going to come has already come because yields have been so low for so long? I feel like I've been saying this for the past decade. Yields are so low, has issued already. Is there a risk, though, that the supply is gone and then the demand continues to outweigh?
We don't think so. We think that you're always going to find issuance when there's demand for that. And we still think that that's going to continue to happen because you are seeing a tremendous amount of still demand. Now, if that pulls back, that's where concerns start to happen. But from an issuance perspective, I don't think that there's anybody that would look at their capital stack ranks and say that at these given levels, it's not opportunistic to potentially issue debt, especially if demand exists.
Gershon, final comment to you. If we are mid-cycle, do we still see a lot of new issuers come to market, take advantage of these low yields, and demand can meet it?
So I agree with George that when there's demand, supply gets created. But if you look at history, when that happens, especially in abundance, bad things tend to happen. It happened in the mortgage-related markets prior to the financial crisis. It happened in the energy space. There was a lot of demand back in 2014, 2015. So that's my caveat. Existing triple Cs might not be so bad, but you got to be really, really careful because of that strong demand, the more marginal companies are going to be able to come to market, and you got to be really careful about where you invest there.
Everyone sticking around with us. We still got one more block, and that is going to be the final spread the week ahead, featuring a virtual meeting of G7 finance ministers and central bankers. Conversation is next. This is Bloomberg. I'm still Taylor Riggs, still in here for Jonathan Ferro, and you are watching Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, EU leaders meeting with Brussels on Monday. The Fed remaining in focus with Brainerd, Mester, George, and Bostic all speaking throughout the day. Plus, there is no shortage of economic data here in the United States. You have consumer confidence, durable goods, GDP, jobless claims, and U.S. personal income and spending all throughout the week. Noelle, Corum, Gershon Distenfeld, and George Rusnak still with us. Noelle, let's just go down through the line. Anything next week or in the few coming weeks that has the ability to potentially move the markets here?
Not a ton. I think the Fed rhetoric is going to sound very similar. There's not a lot of data to really change that picture. Consumer confidence is something that we'll be watching as well. We do have jobs the week after, which is going to be very important to make sure that we're seeing that progress towards lower unemployment. And then, of course, over the coming months, the main thing we're going to be looking for out of inflation is in the underlying data, making sure that data is still looking to be transitory, still related to the reopening of the economy, shortages, supply chain disruptions, all of those things, rather than wages and shelter. If we do see a bump in wages and shelter, I would, pay attention to the longer term trends and if we think it's sustainable. So just something to note as we think about the coming months.
Gershon, all Fed speak next week. What are you keen on hearing?
Yeah, look, I don't think a lot's going to come out from the data that we're seeing, because the issue, again, is not what the data is telling us today. We're expecting high inflation. We're expecting a robust recovery and high growth. The question is, where are we going to be 6 to 12 months from now? Is the economy going to get to some equilibrium? I think what we should be looking for, though, on a global basis is more of a divergence of central bank policy. You know, for a long time, all the central banks, the major central banks, were keen on keeping longer term bond yields low, and we're using yield curve control and other tools to do that. And that's still going to be the case in Europe and Japan. It makes sense where the recovery is going to be slower there. Inflation is not as much a concern. But the Fed has made very clear, I think it's made very clear, maybe it hasn't made it clear explicitly, but what they're telling us is we need optionality. We need the ability to pivot. And pivot's not going to necessarily happen based on the data that comes out in the next week or month, but what expectations are over the next few months.
George, trick question. I don't care about what you think next week. I want to ask you a rapid fire question that I'm eager to get to, and I want to go down the line. Do we get a 10-year yield at a 2% by year end?
We think so. We think it's likely you could get 2 to 2.25 by year end.
Noelle?
Same. Yep. That's what we're calling for.
Gershon?
Yeah, highly likely. Probably closer to 2.25.
Oh, well, that was boring. Let's try investment grade or high yield, George.
I'd stick with BBB investment grade right now.
Noelle?
High yield.
Gershon?
I'd go high yield, but I like EM even better than high yield.
And inflation is transitory. Are we yeses all across the board?
Yes.
Yes.
Relatively speaking.
Okay, that goes down in history as the worst rapid fire ever, but that was not the worst panel I've ever had. That was one of the best. Noelle Corum, Gershon Distenfeld, and George Rusnak, thank you as always for joining us on this Friday. And from New York, it does it from me. Jonathan Ferro, of course, will be back next week, we hope, at 1 p.m. New York, 6 p.m. in London. This was Bloomberg Real Yield, and this is Bloomberg.